If you move back to India without understanding one tax rule, you could lose lakhs of rupees completely unnecessarily. It's a short window built into the tax code. Most returning NRIs never claim it because nobody told them it existed. It's called the RNOR window. Here's exactly how it works. Quick background. When you move back, India doesn't treat you as a full resident right away. For your first 2 to 3 years, you get a transitional status called RNOR, resident but not ordinarily resident. During it, your foreign income is generally not taxed in India at all. But here's the part that makes the magic work. At the same time, your RNOR in India, you've also become a non resident of the US. And a US non resident is generally exempt from US capital gains tax on selling US stocks. So during this window, you're outside capital gains tax in both countries at once. Neither one has the right to tax the gain. That's the gap. So here's how sophisticated NRIs use it. During the window, you sell your appreciated shares, paying zero tax, and then immediately buy them back. That single move resets your cost basis to today's higher price. Later, when you're a full resident and eventually sell, India only taxes the growth above that new higher basis. Every rupee of gain from your years abroad is permanently wiped off your future Indian tax bill. It's called a cost basis reset, and it can save lakhs. If you're a returning NRI figuring this out, hit subscribe. I break down one important decision like this every week, the kind most people discover after it's already too late. This reset works on your liquid investments, US stocks, ETF funds, and vested RSU shares. It does not work on your 401k or IRA. Those are ordinary income, not capital gains. And be careful with real estate. US property is taxed by the US even for non residents, so the reset doesn't apply there. So think of this as the strategy for your stock portfolio, not your house and not your retirement accounts. But, and this matters, there are traps that can destroy the whole benefit. 1. The US calendar year trap. If you spent more than 183 days in the US during that calendar year, the IRS can still tax your gains at a flat 30%. Sometimes that means waiting until January to sell. 2. Where the money lands. The proceeds must first be received outside India. Route the cash straight to an Indian account, and you can lose the exemption. And 3. It ends. Once you become an ordinary resident, your entire global income becomes taxable in India. This window does not come back. Here's a bonus most people miss. Your residency each year is decided by one thing: days in India that financial year. The line is 183 days. Return before October, and you'll likely cross it, starting your RNOR clock immediately. But return after roughly the 1st of October, and you stay under the line. So you remain an NRI for that year, and your RNOR window doesn't even start until the next April. Timing your move by a few weeks can hand you an entire extra year of tax free planning. So confirm your exact dates with a cross border advisor. So, to bring it together, during your RNOR window, your outside capital gains tax in both India and the US. You can sell and rebuy your foreign shares to reset your cost basis, permanently erasing years of gains from your future Indian tax. It works on your stocks, ETF funds, and RSU shares, not your 401k and not US real estate. Watch the 183-day US trap. Keep the proceeds offshore first, and remember it ends when you become a full resident. Used well, this is one of the most powerful and most overlooked moves a returning NRI can make. But please hear this clearly: the timing and execution here are unforgiving. One wrong date can cost you 30%. This is a concept to plan carefully with a qualified cross-border advisor, not a do-it-yourself move. If this helped, my videos on your 401k and on US estate tax go deeper on the rest of your money. This is education, not financial advice. Thanks for watching.